Hello everyone, this is Dr. Sonam Arora. Welcome you all to the next video session on theories of capital structure. In our last video session, we discussed about the model without text, and today we are going to discuss about the same model with text propositions. So, in year 1963, a fellow paper is published by the Modigliani and Miller in which they relax the assumption of no corporate text. So in our last video session, we discussed about the model in which the basic assumption is that there is no text. But in practical life, it is not possible, and the next proposition is given by with the calculation of texts. So now when we talk about the proposition with text, we are going to find out that the value of a leveraged firm is always greater than the value of unleveraged firm. So here I'm going to tell you again what is a leveraged firm and what is a unleveraged firm. So any firm which is totally based upon the equity capital structure is an unleveraged firm because you are not using any debt capital. And the firm which are using a debt capital in their capital structure is called as the leveraged firm. So what this proposition used to say that the value of an leveraged firm is always greater than the value of an unleveraged firm. Now the question is why, and this question is solved by the theory. Now look at why this happened. The thing is that the interest is a tax deductible expense. Thereby, the effective cost of debt is always less than the fixed interest rate. Now, do you remember when we talk about the operating income, how we get it? So it is your EBIT. So when we use the word EBIT, earning before interest and tax, we used to deduct interest. So interest is our tax deductible item. By reducing interest, we are able to get the EBT, earning before tax, and then we deduct tax from this, and we are able to get the net income. So before we go for the equity shareholder payment, we already deducted the tax. So the dividend payment to the stockholders are not the deductible item. Therefore, the value of a leveraged firm is higher than the unleveraged firm. It means in this whole concept, we are able to understand that interest play a very important role. So the higher interest, higher the amount for the company. How can this possible? So it is possible in this way that if the interest rate is higher, the less amount remains for the tax. So the amount which is deducted from the tax remains less, and it will increase the value of your firm. Now look at it like this way. So if there is more debt, it will lead to more interest. For example, if you are having 2 lakh rupees debt capital with a 10%, it is 20,000 rupees. Whereas if you increase your debt capital from 2 lakh to 4 lakh, your interest is also increase. It increased from 20,000 to 40,000 if we go same for the 10%. So the more debt, it leads to more interest. The more interest leads to the higher interest tax shield, and this will lead to the larger firm value. It means the basic difference between the two firm, when it is a leverage or when it is an unleveraged, the basic difference create from the interest. And remember here, when we talk about the leverage and unleveraged, basically it's never been about the total equity company or a total debt company. It is always a competition between the more debt and less debt. So when there is less debt, there is less interest rate. When there is more debt, there is more interest. So the basic difference is created by the present value of that interest which we are going to pay over the period of time. So when we talk about the leveraged firm, it is basically the unleveraged firm with the getting a benefit of a present value of an interest tax shield. Now you ask me what exactly the interest tax shield is. So when we talk about any particular expenses, either it is your depreciation or any other expenses, understand this thing that any expenses will going to reduce your overall profit. So when there is less profit, you have to pay less tax on that. So the interest is again one type of an expenses. If you increase your interest, it will going to reduce your profit, and you have to pay less tax on the profit. So basically your interest tax shield is nothing. It is your particular expenses multiplied by the tax rate. So if you said that your expenses is interest here, then your interest tax shield is simply interest multiplied by that particular expenses. So here we can use the word debt. So the basic formula will be debt multiplied by the interest rate multiplied by the tax and divided by the interest. If I simplify this particular formula, what exactly I can get? I can get simple debt multiplied by tax rate. So let's assume your debt is 2 lakh rupees and your interest is your tax rate is 50%. So what exactly the amount of your debt remains? So 2 lakh multiplied by 50%, it means your tax is going to reduce that amount by 1 lakh rupees. So the interest tax shield work here to increase the value of your firm. Now let's see how it's going to be happen. If the introduction of a debt will increase the value of a firm and it going to reduce the cost of a weighted average cost of capital, or I can say my KO, cost of capital, whereas my free cash flow remains constant. It means whether you are going to increase your debt capital or going to reduce your debt capital, any change in your capital structure is not going to affect your cash flow, because cash flow is a function of your asset. So the free cash flow remains unchanged whether your debt capital is 1 lakh, 2 lakh or whatever amount. You can easily go and check it out with the help of any numerical. If your debt capital, if your ratio of a debt and equity is a 60-40%, then you change your ratio from 60-40 to 30-70 or any other format, your EBIT will remain same. Why that happened? Because the function EBIT you get from the asset, it is not the function of your liability side. So how can we look at? So we calculate our value of firm in this condition by simply we took the free cash flows and divided by the KO, that is your cost of capital, or you can use the word the weighted average cost of capital. So in the proposition second of the model, you can calculate the value of firm by simply doing free cash flow divided by the weighted average cost of capital. And this is one thing we also do same in the previous theories of the capital structure. There you can use the word net income. Here we are using the word free cash flow on the place of a net income. Now look at the second one. So in this particular formula, how we are able to get your weighted average cost of capital? So we already discussed it many times that how we are able to get the weighted average cost. So it is your proposition of a debt and equity multiply that at particular cost. So here we mention it, the debt proportion. So looking at the debt proportion, it is D upon V multiply by the cost of debt, that is shown by the KD. And the calculation of a tax, that is a very important factor. So we are doing the calculation of tax with that by 1 minus T rate. Plus we are adding the equity proportion, it is E upon V multiplied by the cost of equity by KE. So in this way you are able to get your weighted average cost of capital. And the last thing, how you are able to get your equity cost. So getting the equity cost, again it is total cost plus the proportion of D upon E in bracket KO minus KD. So you are subtracting the cost of a debt from the overall cost, and this way you are able to get the cost of an equity. And the return calculation. So it is very important to calculate return in the proposition with tax. So how you are able to get the return on equity? It is simply the unleveraged firm, the return of an unleveraged firm plus the ratio, the proportion of a debt and equity in bracket the unleveraged firm minus debt capital. So in this way you are able to get the return on an equity firm. So we are going to take it with the help of an example. A firm has a free cash flow of 20 million with an unleveraged cost of capital of 10%. Permanent debt is of 50 million at 8% cost of debt and a tax rate is 40%. So you have to calculate the weighted average cost. So the very first step is calculation of the value in a case of an unleveraged firm. So it is your free cash flow which is given here. So the free cash flow is 20 million. and the weighted average cost is a 10%. So it means the value of an unleveraged firm is in 200 million. And when we talk about an unleveraged firm, it means there is totally equity capital. There is no debt capital. So an unleveraged firm is of a 200 million. It means we are talking about an equity capital. So here your equity capital is 200 million. And sum is already given us the debt capital, which is 50 million. So when we talk about the value of an leveraged firm, it is simply your value of unleveraged firm, which is 200 million, and the interest tax shield which we calculated here. So the interest tax shield leads us to 20 million. How I calculate it? It is very simple. Your debt is a 50 million. I multiply it with the tax rate. So the tax rate is here 40 million. So what exactly you get it here? The value of a leverage firm leads you to 220 million. So what about the calculation of an equity firm? So I already tell you, it is already given in the exam. The value of a debt capital is a 50 million. So the value of an overall leverage firm is 220 million. I deducted at the debt capital, so I am able to get the 170 million. So 170 million is an amount of an equity in a leverage firm. Now look at the what we want to conclude from the approach. So the approach with the corporate tax say that a value of a firm maximized only when the firm used debt in its capital structure. Again, we are on the line of a same theory where it is said that that capital is going to affect the capital structure. But the important point to note here is the extensive use of a debt would expose the firm from a risk of a meeting fixed and promised interest as well as the principal obligation, because it is necessary for you to pay the interest on the debt as well as you have to pay the principal. So it will going to increase your legal and financial risk in long term. Whereas the major criticism of this particular theory is that it is not going to provide you the optimum capital structure, because time and again we are discussing the thing that is going to help you out. But the main question is how much debt, and this theory is not going to answer you that exact question of how much. So what exactly the optimum capital structure, what exactly that ratio where you are going to increase your firm value and going to reduce your weighted average cost of capital. Thus, they suggest to opt for a target debt equity ratio, so not to violate the limit of a debt capacity of a firm. So this particular theory used to help us to understand that debt is a very important obstacle on any capital structure. But what is that point where the debt play a positive role and after that that is going to be a negative role is still a questionable process. So this is all from my side. I hope you are able to go with the references given in there and able to understand this particular theory in detail. Thank you.